Good afternoon. Welcome to the weekly livestock market update. I'm Brownfield anchor reporter Megan Grebner with us as always to talk all things markets. University of Missouri, Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
I see you're wearing your Halloween costume.
That's right. I'm a Mizzou Tiger.
I thought you were a nerdy economist.
Well, maybe that too.
And I'm not going to call it a special Halloween episode, but there definitely are. There might be a little more tricks than treats in this week's report. We're going to talk cold storage numbers. We're going to talk a little bit about risk management as we look ahead to 2023. But to kick things off, let's recap what happened this week in the markets.
Yeah, Megan, this week on the cattle side, we had higher cattle prices. Cash-fed cattle were $1.80 higher this week. Those feeder cattle markets were strong this week, up 2 to 5 across the board. On the future side, December live cattle futures contract was up about 50 cents. Yet the November feeder cattle futures contract was down about 30 cents this week. Stronger choice box beef up $9.25. Ribs and chucks kind of led the way this week in terms of those higher choice box beef prices. On the hog side, cash barrels and gilts were down 25 cents this week. The December lean hog futures contract closed down a little more than $3. The pork cutout value also lost this week, down $2.50, and every component of that cutout value was down this week.
It's definitely interesting to see where prices are going, especially relative as we think about input costs as well. And really not a great week on the corn side of things either.
Yeah, that's right, Megan. I mean, we continue to talk about what's going to be a potential squeeze as input costs stay high, and although we got some strength in prices, we're certainly talking about profitability that remains constrained at best.
All right, let's get into these slaughter numbers as we take a look at both the cattle and hog side of things.
Yeah, USDA is telling us for the week ending October 29th, a run of 668,000 head of cattle this week. That's 5,000 less than where we were a week ago, but unchanged relative to a year ago. On the hog side, a run of 2.557 million head of hogs this week. That's down 14,000 head from where we were a week ago, up slightly, up 5,000 head to where we were a year ago.
Year to date, are we starting to continuing to play catch up a little bit on at least the hog side of things?
We are. Hog slaughter year to date now down 2.9%. So we continue to trim from what was a stronger downward in the early part of 2022. Let me get the right year here. Yet on the cattle side, 1.6% more cattle slaughter. I think we continue to see larger runs as we are seeing drought affecting producer decisions about dispersal, especially on the beef cow side of the equation.
Cold storage is the only report we have out this week. Let's talk a little bit beef and pork, and then I want to get into the poultry side of things because we're heading into turkey season.
Yeah, that's right. So when you look at beef ending stocks for September of 2022, we were actually up relative to a year ago. Nearly 19% in terms of beef ending stocks, so higher relative to the previous month as well. I will say, just don't forget, beef ending stocks for September relative to the 2015 to 2019 average, only up 5%. So we're kind of getting back to where we were, I'll say, pre-COVID. On the pork side, we are 14.5% higher on pork ending stocks relative to a year ago. That leaves them still 13% below a year ago levels. Hams in particular sticks out of the report that we got this week, being down 18% relative to a year ago, and ham ending stocks 30% below where we were 2015 to 2019. In contrast to belly stocks that I know you watch all the time, Megan. Belly stocks 2015 to 2019. September of this year was up 43%. So we've been growing those belly stocks. Again, I want to be a little careful there. That doesn't take much of a change in belly stocks to talk about a large percentage change.
Let's get into turkey and chicken specifically. We're heading into the turkey time. It's time to talk turkey. Turkey stock shrunk again. However, looking at those in comparison, they're down a lot. Talk to me a little bit about what we're seeing and what that means long-term for prices.
Yes. So just a little perspective here. So September 22 turkey ending stocks, 395 million pounds. You just divide that by population in this country, and we all get a little more than a pound. Now, let's be careful with that because that's just stocks at point in time, not production. But those stocks down 4.8% relative to where we were a year ago at this time. But maybe most important, when you look at that 15 to 2019 period, down nearly 25%. So it is fairly tight in terms of turkey ending stocks. It'll be really interesting to see where those prices go come Thanksgiving and even into Christmas, where we traditionally see a lot of turkey consumption happening.
In addition to a higher potential price point, do we need to worry about availability at Thanksgiving and into Christmas as well?
So I think there'll be availability. It may just be at higher prices, but maybe shorter supplies than normal. Maybe those waiting for the really best deals at the grocery store on that holiday turkey may find those hard to come by for the first time in a while. But I think availability wise, we'll find availability.
Chicken. I'm assuming I might watch bacon, but I know you're a chicken wing fan. What's going? Are we seeing a reprieve in chicken wing prices also?
Well, I think we're seeing some for sure. And I'll say this is one that deserves a lot more discussion, especially even back to beef and pork markets in particular. Chicken ending stocks for September of this year at 873 million pounds. That's 18.5% above where we were a year ago at this time. Now, relative to 2015 to 2019, it's only up 2.5%, but it's an industry or a sector, a meat sector that's changed as we started early this year talking about high chicken prices, lower supplies. High path AI had a lot to do with that discussion. When you look ahead, pretty strong growth in production's been happening of late. Now, we don't know what this winter looks like, and we don't know exactly what happens in terms of high path AI cases. It could change this outlook, but it looks like we got cheaper chicken coming in 2023. And you add that to what's a potentially weaker economic situation. Kind of wonder if consumers might find themselves with a bargain on chicken relative to beef and pork in particular.
As we wrap up today, we're going to talk a little risk management, thinking ahead to 2023. We have talked plenty about the fact that there really is potential to be some higher prices on the cattle side of things. I don't want to say pessimistic, but looking at it, taking a broader scope, I guess I have some concerns about potential and the ability for prices to hold on as we continue to see some slowing of economies and some continued economic pressure. What do we need to think about, and what are you looking at as you're looking ahead to next year?
Yeah, so first of all, I think it's important for us to be talking about a lot of those forecasting the general economy now are saying in 2023 we're going to have negative real GDP growth for the year. That's a change relative to what's been positive up until now for 2023, albeit weaker than normal. But I think for this discussion in particular, I kind of think about this in a table format. So number one, let's look back historically at years where we had decreased beef availability. So this is kind of a calculation where we're going to look at total beef production, subtract out what we're going to export. and talk about that availability for domestic consumers versus real GDP growth years that were less than 2% and those greater than 2%. So the easy thing to say here is when you have decreased beef availability and you have real GDP growth greater than 2%, you're generally going to get higher real fed cattle prices. You look over the 1980 to 2022 period, that they were 4.6% higher in those years where, again, real GDP grew more than 2% and we had decreased beef availability. 2003, 2010, 2014 are some of those years where that was really strong. Now, where are we going to be in 2023? We're going to have decreased beef availability. We know that, driven in part by drought, driven in part by reduced profitability with these high input prices. We also likely have real GDP growth less than 2%. You look at those years where we've seen that historically, and over the 80 to 22 period, those years averaged 0.3% lower real fed cattle prices. However, when you look at years where there was going to be negative GDP growth, those years very clearly down 2% in 2008, down 11% in 2009, just reminds us that in my book, if economic contraction gets worse, we're going to talk about lower fed cattle prices. So to risk management, I just keep saying, hey, don't forget this kind of general economic outlook could take the shine off of what otherwise might look like a pretty good year coming for cattle prices.
Would you say we are in a better position, or we should be better positioned to be proactive in terms of risk management rather than reactive to what could start happening?
So I think there will be opportunities. Megan, as you and I have been talking, there are higher cattle prices as we've gone through the year. We're setting $25 a hundred this week over where we were a year ago at this time. Yes, input prices are still high, feed costs are still high. I don't want to equate that we have $25 more of profitability on a per hundredweight basis. We've got higher cattle prices. I say that because we have opportunities to lay off some risk potentially that we ought to think through. And so I think there are those opportunities. I just don't want producers to get in this frame of mind where, hey, the economists keep talking about just how short supplies are going to be, and we could get record cattle prices. So there's only one direction for them, which is higher. And I go, I still believe that might be the case, but I want to highlight this general economy situation is one thing that could derail that. So let's not just get in the mindset of I don't need to do price risk management because prices are always going to go higher. Be thoughtful about, hey, they're high enough. Maybe I'm going to sell 25%. Pick, and I think this varies by operation, but figure out how much risk you can handle. And maybe you let someone else, own some of that risk. I think there are just opportunities coming for that to happen.
Scott, always appreciate your insight. As we look ahead to next week, what reports are we watching for?
Yeah, so we'll get next week Restaurant Performance Index. We'll also get a jobs report, which will be very interesting to see. And we finish next week with monthly trade data.
Sounds great. We will talk to you next Friday.
Sounds good, Megan.
So our weekly livestock market update delivered to your email box every Saturday morning. Go to brownfieldagnews.com. You can also submit questions and comments there. And for market updates, check out John Perkins' Market Minute in the afternoons. Have a great weekend. I'm Megan Grebner for Brownfield.